Hi guys, this is Mrs. Scherenberg. I have the Chapter 11 lecture here. I feel like this is a challenging chapter. I really hope you take the time to print out these lecture notes and listen to this and take notes as we go. I am going to be going over quite a few examples that link right up to the homework. So anyway, Chapter 11 is about liabilities, specifically bonds payable. So just to kind of review here, there are two types of financing that a corporation can utilize to get cash to raise funds, okay? So the one type is equity financing, and this is any time that a company sells stocks. So the investor who buys that stock gets ownership and equity in the business. And the other one that we're going to talk about is debt financing. It could be short-term, could be long-term. But an example of this is something called bonds. So the investor gives money to the corporation, and the corporation can use that money, but the investor also earns interest. And you'll see that on almost all of these problems, the interest payments are twice a year. And then at the end of the term, the investor will get their investment back in total, plus all those interest payments they have earned. So all about bonds here. The face amount of a bond is called the principal. And the underlying contract is called a bond indenture. Starts with an I-N, ends with denture. This contract lists the face value, the contract interest rate, the term, and when interest is paid. Again, you're going to see this twice a year on almost all these problems, so might as well get used to it. When all the bonds of an issue mature at the same time, they are called term bonds. If the bonds mature over several dates, they are called serial bonds. Serial, not cereable. Serial bonds. Convertible bonds may be exchanged with common stock, while callable bonds, may be redeemed prior to maturity. We have a homework problem on a callable bond, which we'll go over here in a little bit. When a corporation issues bonds, the price for investors to pay for the bonds depends on what is the face amount of the bond, what is the contract rate of interest, and then what is the market rate of interest. If the contract rate, the rate that's stated in the contract, if that is equal to the market rate, the going rate in the market, the bonds will sell at their face value, face amount. And this is obviously the easiest scenario. If the contract rate of interest is less than the market rate of interest, the bonds will sell at a discount. Kind of like bonds are on sale. We're selling it at a discount. If the contract rate of interest is greater or more than the market rate of interest, the bonds are said to be sold at a premium. And this next graph was taken out of your textbook. So again, if the market rate is greater than the contract rate, then it's a discount. If the rates are equal, face amount. If the market rate is less than the contract rate, premium. So now we're going to get into the accounting for bonds payable. Bonds payable are, first of all, usually reported as long-term liabilities on a corporation. So the corporation is going to have to pay these back. And if there is any current portion, like if the bonds are due within 1 year of the balance sheet, they're reported as a current liability. Now, if there's a discount involved, which we'll talk about here, a discount on the bonds is reported as a deduction from the related bond payable. And the premium, if there's a premium, then it's reported as an addition. And this, we're talking about what would this look like on the balance sheet. Eventually, we'll see it. When bonds are issued at less or more of their face amount, the discount or premium, that extra amount, and we're going to do something to it, and it's called, it needs to be amortized over the life of the bonds. At the maturity date, the face amount must be paid. So that's a lot of words and it's a little confusing. I think you'll understand it when we jump into a couple problems here. Okay, so first of all, here we have bonds issued at face amount, meaning the market rate of interest and the face amount interest is equal, 12%, okay? So let's jump in here. January 1st, 20Y5, Eastern Montana Communications issued the following bonds. So Eastern Montana is trying to raise money. They go out there and they have these contracts. Anyway, they raise $100,000 worth of bonds. It has a 12% interest and the term is 5 years, okay? So the journal entry for the issuance of these bonds looks like this. January 1st, they got cash. They raised cash of $100,000. Then they're gonna credit bonds payable for $100,000. Okay? There's no discount, there's no premium because the interest rates are the same. Now, let's record every 6 months for this same thing on June 30th, December 31st. There's an interest payment of $6,000 that is paid. So we're going to journalize the first interest payment for June 30th. Now, mind you, June 30th, December 31st, they'll be identical. And how did they get the $6,000? They took the $100,000 base value times the 12% annual interest rate, and then they took it times a half a year because the payments are twice a year. You could also think of that as either take it times a half or divide by 2. You'll see me do it both ways. But since they've already calculated the $6,000 for us, June 30th, they're going to go out and they're going to pay the bond holders some cash. So on the corporation books, it's interest expense of $6,000 and cash of $6,000. Now, the December 31st would be identical. Okay. At maturity date, let's pretend it rolls around. How long is this thing out? 5 years. At maturity date, the payment of the principal of $100,000 is due, and it's recorded as follows. So December 31st, bonds payable, finally going to clear out this account with a debit, and they paid that back with cash. Okay, that was the very most simple one because the interest of the market equaled the interest of the contract of the bond. Now let's jump into one where bonds are issued at a discount. So right away, you should look at the percentages and you can see that 6% is what is on the contract. And let's see, right here is where you get the idea, the 936,420, is that these are going to be offered at a discount. So on January 1st, the first day of the fiscal year, Nixon Company issues a $1 million 6% 5-year bond, receiving cash of 936,420. So since it's less than that, it's a discount. The bond pays interest twice a year on June 30th and December 31st. And this problem we need to amortize using the straight line method. So this one, we're going to issue the bond. And this is what it looks like. So January 1st, they didn't get that full amount of 1 million cash. These were offered at a discount, so they received 936,420. They did still receive a lot of cash. Then the next line down is called discount, and it's supposed to be a debit too, so this was also a debit. And then the third line is going to be the bonds payable. Now the bonds payable amount is always the face amount. So you can kind of tell yourself that that's always the face amount, the amount that goes to bonds payable. So the difference between the 936,420 and the 1 million is the amount that goes to the discount. Let me just fix this a little bit. Okay, so let me move this over here so it all lines up. 936,420. And then again, the difference between this is 63,580. Now we are going to have to amortize this amount. And we don't see that until we get to the interest payments, but this says amortize, and here's what I'm going to do. It said doing the straight line method. So I'm going to take that 63,580 number and divide it by the number of interest payments. Okay, and in this case, this is a 5-year bond with interest payments twice a year. So there's 10 total interest payments. So if I divide this by 10, this number that I'm going to be using here is 6358. Okay, I'm going to say it one more time. When we figure the amortization, we take the total discount amount, 63,580. We divide it by the total number of interest payments, which in this case is 10, because it's a 5-year bond with 2 payments a year. So 63,580 divided by 10 is 6358. Now we're going to use that number on the next one. So now when we journalize the semi-annual interest payments on June 30th and December 31st, it will look like this. And both payments will be identical. So June 30th, we're going to have, here's our accounts. We're going to have interest expense. Then we're going to credit discount on bonds payable, discount on bonds payable, and we're also going to credit cash. Okay, now how much interest do we have to pay here? Well, we're going to calculate this interest based on the face amount, 1 million times 0.06, and then I'm going to divide that by 2 because there's 2 payments per year. That number becomes 30,000. Okay, so the cash paid out is 30,000. This discount on bonds payable, this is that amortization number, 6358. And then these two numbers added together is going to be the interest expense. So 36358. Okay. December 31st payment is identical. Now let's think about what's happening here. What we did right here was we calculated the interest. We used the face amount of the bond, the 1 million, times the 6%, which was the contract rate. And then we divided by 2 because there's 2 payments per year. That's how we got to the 30,000. That's where that cash number goes, okay? Then the discount on the bonds payable, if you think about it, we divided the total discount, 63,580, divided by 10. So every time there's going to be 10 payments. Every time we do one of these journal entries, it's going to eat away at that full 63,580 until it totally brings it back to 0. And then when you're doing a discount, the interest expense, you add those two numbers together. Now, this one is bonds sold at a premium. So the bond contract is a 2 million, 8% 5-year bond, but this time look at the amount they got of cash up front. It's more than the bond contract. So this one's going to be sold at a premium. It's very similar to the last problem we did, but you'll notice some of the debits and credits are opposite. Again, the payments are twice a year. So it is still a 5-year, 2 interest payments a year. So again, we have a total of 10 payments. We're still going to amortize that using straight line. So first, let's journalize the issuance of the bond on January 1st. So January 1st, they got cash of the bigger number, 2,170,600, because these bonds were sold at a premium. Then on the last one, you might go back and look, but it was a debit to discount on bonds premium. Well, when it's a premium, it's going to be a credit to premium on bonds payable. And then bonds payable is also a credit. That's always the face amount, right? Face amount. So the difference between this, it's 170,600, is a credit to bonds payable, premium on bonds payable. Now, I'm going to have to figure the straight line amortization of this. So if I take the 170,600 and divide it by 10, because there's 10 total interest payments, I'm going to get 17060. So I'm going to be using that number on the journal entry we do for the semi-annual interest payments. Okay, so sure enough, here we do. We have our semi-annual interest payments, June 30th, December 31st of the first year. And we are going to go ahead and bring in that amortization amount. So this is what this entry looks like. June 30th, we're going to have our interest expense. Then we have a debit to premium on bonds payable. And then we have our credit to cash. So let's figure out, I mean, you'd have to go back and look, but let me give you the numbers. The contract bond amount was 2 million. Notice I'm using the contract amounts, 2 million times 0.08, because it was 8%. Then I'm going to divide that by 2 because there's 2 payments per year. Once you take 2 million times 0.08 divided by 2, you get 80,000. And that amount goes to cash. Okay. Now, the premium on bonds payable, if I come back and pick up that number, it was 17,060. It's going to be a debit when it's a premium. 17,060. Now, I'm going to back into this interest expense by taking the 80,000 minus the 17,060, and that number is 62,940. 62,940. Okay, this next one right here, it relates to homework 11.05, but so use this when you're trying to get that one done. A corporation may redeem or call bonds before they mature. This is often done when the market rate of interest declines below the contract rate of interest. In such cases, the corporation may issue new bonds at a lower interest rate, use the proceeds to redeem the original bond issue. These types of bonds are called callable bonds. Very complex, hard to understand all the intricate details here, but we will do the accounting. Okay, this first blank is a gain is recorded if the price paid is below the bond carrying amount, and a loss for a company is recorded if the price paid for the redemption is above the carrying amount. Okay, so here's our company. It's Whirlpool. They issued a $20 million 20-year 7% callable bond on March 1st at their face amount. So we don't have to worry about discount premium here, with interest payment paid twice a year. Journalize the entries to record the following selected transactions. So we have 3 journal entries here. The very first one is March 1st, when they issued the bonds for cash. They got 20 million cash that day. So let's come down here and let's do March 1st. And I guess I should put 20Y2. 20Y2, March 1st. They got a whole bunch of cash. 20 million. And it's just, we're just going to credit bonds payable. There's no discount or premium on this one. Bonds payable, 20 million. Then let's go ahead and calculate the interest payment on the bonds. So we're going to take 20 million times 7%, and we're going to divide that by 2. And the number that you get when you do that is 700,000. And again, there's no discount or premium. So it is simply interest expense. Interest expense and cash for 700,000. All right. And then finally, the last journal entry in 20Y4. So a couple years go by, they've continued to pay these interest expense, and stuff is happening in the market. They decide to call the bond in, and the lingo is like this: we called the bond at 102. So what you're supposed to do is, I'll show you in a minute, but all you do is you take the 20 million and you take that times 102%. That's what the 102 signifies. And that number becomes 20,400,000. And that is going to be our cash amount. So they, not only did they owe the folks the 20 million, they called it in at a higher amount, and they're going to be paying 20,400,000. So extra 400,000, really. So this is a 3-liner. It is September 1st. Bonds, let's write out the 3 accounts. Bonds payable is a debit. We're going to have a loss on redemption, which you guys probably know that's 400,000. And then the full cash amount they had to pay to redeem these bonds, 20,400,000. The amount sitting in bonds payable originally was 20 million, so we're clearing that out. And then the difference between these two, this needs to be a $400,000 loss, which is losses or debits, gains or credits. And again, have this out when you're doing your 11.05. It should really help you. All right. This next one is going to be the last one, and then I'm going to shut down this lecture and finish the last with the practice problems. This one kind of goes with 1106 homework. Very similar. It's a callable bond. Windy Corporation produces and sells wind energy-driven engines. They issued a $28 million 20-year 5% callable bond on May 1st, and at their face amount, with interest payable twice a year. And the fiscal year of this company is the calendar year, and we're going to journalize some entries. Okay, so 20Y5, May 1st, is simply the day they got all that cash in. Cash, 28 million. Again, it's a face amount, so there's no discount or premium to worry about. We're just going to set up a liability, bonds payable, for 28 million. Then on November 1st, it's time to do that first payment. Let's go ahead and calculate that. We're going to take the 28 million times the 0.05 and divide that by 2. And that number is 700,000. So when we record the interest expense, this is just going to be a 2-liner. Interest expense is 700,000, cash, credit 700,000. Those are the payments made to the bond holders. All right, then several years go by. It's 20Y9. They called in the bond issue at 97. So the number we're going to be working with, we're going to take the original amount, 28 million, times 0.97, or 97%, however you want to run that. And they're calling that in at 27160,000. That's going to be our cash entry number. So they're going to have a gain on this because originally they owed the folks back the $28,000, and now they're only going to owe them $27,160. So this is a three-liner with a gain, and gains are credits. So November 1st. The debit account is bonds payable. It's the same amount as what we originally set it up for, $28 million. Then we have a gain on redemption. Credit of, I'll put that number in there last. The cash amount, which we've calculated, is 27160,000. So this number right here is the difference between these two numbers, right? Difference. Because it has to be a credit for one thing, and the credit amount is 840,000. All right, I'm going to end this first part of this lecture here because it's getting kind of long, but we're going to come back and do this pricing of bonds, which is also like 1112 and 1113, and we're going to use these tables. So come back and watch the second part of this lecture, and then I'm going to go on to our practice problems as well.